Hi, welcome. Today I wanted to talk about broadcasting services, series, movies, etc. We'll be doing fundamental analysis of this part of the market. We'll look at companies like Walt Disney, Warner Brothers, Netflix, and CLIQ Digital. And we are going to be using the Warren Buffett's approach. So we are going to be looking at a long-term investment with the use of value investing. What does it mean? We'll look at the current price of the stock. Let's say that this is the price chart, and now the stock price is at $50. But we'll look at the company itself, and let's say that this company is making $10, or maybe let's make it bigger so it's more obvious, $25 per share. So if we per year, per annum. Okay, so this company is making $25 per share, and we can buy one share for $50. We can also think about it in terms of buying the whole company, and that's how Warren Buffett does it. So instead of looking, you can look at the per share data, but you want to be thinking about like you're about to buy the whole company. So it's not like some random thing, random price chart on the internet. You are not buying the ticker, the chart. You are looking at the real business. You are looking at the business itself, and you are trying to figure out, is it a good business or a bad one? So you can also look at the full scope of things. So let's maybe say that the full company can be bought for 1,000. That would be a billion, right? For 1 billion. And the company is making 0.5 billion per annum, per year. That's the profit. So it would be very cheap. You would get plus 50% each year. So that's a very obvious example. And that's the approach of Benjamin Graham, the teacher of Warren Buffett. That's what he was looking at. And okay, so he says that it's very cheap, so maybe the price of the business, if the general stock market, if we look at indices, or maybe we compare it to some other type of investment, maybe you can also compare it to bonds. Of course the risk is much different, but maybe you want to invest some money in stocks, some money in bonds, and you're thinking, okay, what proportions? Is it right now a good time to invest in bonds or maybe in stocks? So you can compare other types of investment and also different companies. So here we will be looking at 4 different companies. So if we can see that one company earns 10%, the second 15%, the third one 12%, and the fourth one 50% per annum, that's a huge opportunity to buy, right? So that company, if it's making $25 per share and the rest of the companies had returns of around 10%, so the price should be $250. So we should have a price in the long term should come back to the real value of the business. It looks a little bit different, like this. So this is the real value. Let me grab the black pen. Real value, and that's the price, so maybe it is like a little bit correlated, maybe it's not, but in the long term it is, like you can expect it to go back, because when I'm talking about long-term investing for Warren Buffett, it's a minimum of 5 years, so it's a long time. The optimum, I would say, is around 10 years. So you freeze your money, you get it into the market, you wait as long as possible, and you get out, because the time is the most important thing, is the compounding interest. So for instance, if you invest some amount now, for instance, let's say that you are 30 years old and you expect to go to retirement around age of 65. So each 1,000 now that you invest, and let's say that you are not going to beat the market, so you will get around 10% minus the taxes, so that's 8% per year. But if you are using a special accounts, they are connected to retirement. It has different names in different countries, but those accounts, you don't pay taxes on them when you hold it to retirement. So I'm using that account. I highly suggest that you use it too. We'll calculate the return for long-term investment with that account and without it, because it should be a difference, although it's just difference between 10% a year or 8% per year. But when you think about it, okay, I pay 20% in tax, that's a lot. And in some countries with some amount of income, you will pay much more, but in here I'm talking to the general public. So it's 8% with the taxes, and let's say there's inflation, because we want the real income. That's when you invest in bonds and you get 10% when there's 20% inflation or 10% inflation. You don't earn any money, of course. So let's say that we get inflation of around 3%. Let's say it's bad. So we go down from 8% per year to 5% per year. So in here, without this account, sad face, I will be making 5% per year. And in here with this account, we won't be paying taxes on that money, which is very important. And we'll earn 7%. So as you can see, it's a big difference. The earning power goes up by 2 percentage points, which is in this case around 40%. Okay, let me calculate that real quick. So we have 35 years till retirement, and those amounts, the first one, each 1,000 will go into 10,000. Okay, so that's nice. We are getting 10x real value. So if you have enough money to buy yourself a nice car, at retirement you can buy 10 cars. If you have enough money to go for a vacation, you can save that money and go to 10 vacations when you are retired. You have all the time in the world, and you can just multiply your money and spend it nicely there. Of course, some people say, when I'm 65 years old, I will be dead. Probably you won't be dead, and probably you will be going to the retirement a little bit later than that, because the life expectancy is going up. But it all depends, Okay, but not to get sidetracked too much, we have to end this calculation. So for the 5%, we will get 5.516. You see, this account connected to retirement, your country probably has it, is very nice. So please use it, because 10x is much better than 5x your money. Okay, so that's what happens when you are super good investor using this approach that I will be using here, and the competitive advantage approach that I will explain in a second. You can get much more money, because instead of making 10% base, you can be making around, okay, it really depends, because if I say that you can make 50%, yeah, you can if you are really good. because it's a competitive thing, you know. On the stock market, somebody has to lose money in order for you to make it. So it's not difficult to do it, but you need to have the right approach, and we will be talking about the approach. We are talking about it right now. This is one of the ways to beat the market and have great returns. But so let's say that you managed to learn. You didn't get the 50% that Warren Buffett says that he could get right now with small sums of money. Let's say you only did 20%. Oh, so you're not even half as good as Buffett. But look how that changes. Let me just do minus the taxes, or maybe with the special account, because I hope you will use it and I will too. Minus the inflation, let's go with that 3%, and time is 35 years, so that 1,000 changes, doesn't do times 5 or doesn't do times 10, it does times 243. Okay, so each 1,000 will turn into 250,000. So if you save 4,000, you can do it. I believe in you. You can just save, I don't know, 200, 100 a month, and that will be enough for you to retire a multi-millionaire. And this is real value. Of course, in different countries you'll have different rates of inflation, but remember that you are buying businesses. You are not investing on your bank account. You are not holding cash, you are holding companies. So when the inflation comes, your company will hopefully be able to raise the prices. Okay, so that's nice. A very nice thing that I found out is that during the COVID pandemic, the companies actually increased their margins. At least that was the little study done based on the US market. What that means is that they rose prices more than the costs rose, so they profited of the COVID. Basically, the thing that you are paying more is a good way for them to earn more money. They just rose the price a little bit. You didn't complain. Inflation was everywhere. It was, Putin is bad. What else? COVID is deadly. I mean, Putin is bad, so the COVID is also deadly. Depends how old are you. If you are in the special, like, for instance, my grandma, more deadly than for me, right? But without that account, it would be much less. So minus 20% in taxes. Okay, I'm not sure about this one. I'll make an estimate. Okay, so it would be times 98. So you will lose a lot of money. It will be only around this much, 400,000. So more than, it's like 60% loss on your potential profit if you are not using the accounts or other ways to legally not pay taxes, because there are ways to do that, of course. Alright, what am I doing? Let's start at the beginning. So we are going to start with the fundamental comparative ratio analysis. The first company, CLIQ Digital. It's a smaller company. It has actually a little bit different business model. They say they are not like the rest. They have different things. So they actually have something is like gaming on virtual machines, if I understand correctly. They have movies, right? They have also books. Those are ebooks, so like audiobooks, for instance. You can I think you can read them also, but you can for sure listen for them. So that's really nice, because podcasting is a great thing nowadays. A lot of people like to listen, and audiobooks are like close friends of that. So they have a lot of things, a lot of different things. But as you can see right here, oh sorry, this is not the right one. Okay, so you want to buy the one that's on the German Stock Exchange, etc. Look at the price chart, it went down quite a lot. It went down from the top, from 40 to 6. So that's a huge drop. We can calculate it as a percentage. I will do it for myself. I like to think about it this way. There's also a very nice study done by the Kahneman. He got the Nobel Prize for that and for some other stuff. But basically, okay, I don't remember what he got the prize for exactly, but it was connected to this book that it was in. So when you think, like I'm thinking right now, actively, in a moment, and I try to use statistics in my head. So for instance, if I'm trying to compare this drop of 40 to 6 to other drops, like for instance in here, from 75 to 8, or in here we also have a huge drop. So that's actually, I like to see that. Sadly it's connected to the fundamentals, but in here from 200 to 94, I'm trying to compare those. If the numbers are a little bit difficult, even like in here in CLIQ, if I try to estimate that drop in my head in a short time, I will most likely fail. So make sure that those calculations are correct, or that you are using a calculator. Okay, so this is 85% drop. After looking for it for a long time right now, I would say it was about 75%. My bad, of course. It's easy math, but yeah, I was focused on something else. I didn't really pay attention to that. If I had, take time to calculate that, the me not being mistaken, it's important. So what happened to this company? Why the stock price dropped? So this is one of my favorite companies from here, because it's a small cap, meaning that this company is small for the big investors. I mean banks and institutions, etc. So this company, the whole company, all of the stock can be bought for 41 million euro. So a lot of big institutions don't look at things if they are not in billions. So this company would have to 10x, 20x, 25x actually for the funds to even look at this direction. And I know that some of the bigger funds are not even looking at stuff that is below few billion. I think 5 billion I heard also. So yeah, it's super small, and it's a big company. It's a big company from Germany. So it's professional. It has 140 employees. Their revenues are, it's a quite old, it's not super old, but in here you can see that we can go all the way back to 2009 with this company. So they are in business for a long time. What you can also see is that their earnings shoot up during COVID, which is currently my biggest problem with this stock, is that I'm not sure if that jump in profit was just something that was short term. Look, you see the huge spike. Before it was around 3, and now the operating income jumped up. And here on the Guru Focus, you don't actually see the latest numbers, because for some reason I I mean, I thought Guru Focus was a little bit expensive, so I thought it would have quite new information, but yeah, I don't know, they are just kind of slow, but hopefully we have all of the other places that we can look for instance Yahoo Finance. If you are starting out, it's very nice. You can look at stuff here real quick. You have all of those tabs here on the left. On the phone it looks different, but I like it even more on the phone. If you are looking for something real simple, like some of the basic ratios between like price, earnings, etc., then this is a great website to visit. It shows it very nicely, all of the important stuff. So for instance, in here we have the profit margin, 7.5%, operating margin 0.76%. If we look at the financials here, they will probably be updated because we quarterly, maybe that's why the Guru Focus doesn't have it. Okay, yeah, it kind of broke, I think. Also, when I look quarterly, yeah, it's just not working here, but don't worry, we can go, I think, even to something so popular as TradingView. Alright, and in here I think they also have some fundamentals. What the hell? Okay, Jesus. Let me search for the company. Okay, I will be right back. Alright, so I checked the TradingView and it's actually very good because it's broken, it doesn't work. Like the data is missing, a lot of data is missing. I mean, I checked only 3 websites, but I'm unable to find that information about the recent quarter, which is connected to the price drop. So that's actually very good. For the markets to be efficient, the economists have few rules that have to be in place for the market to be rational, and that is the information should be available. So if currently it's difficult to find information about the CLIQ Digital online and what is happening to the stock price, I don't know, it can be a little bit of a help. So that's always so nice. But look, I found it perfectly here in the financial report. Q1 of 2024, we can see a huge drop, just a massive drop in earnings, and that's the biggest problem. So let's focus on this chart. Give me a second, let me make it bigger. Okay, so as you can see, the revenues were growing steadily in this chart from 2019 to 2023. We can see increase in everything, and it's a steady increase. Of course, the dynamic, how fast it's going up, it can change, but we can see the revenues going up. That's the most important thing, while also the margin, you can see it's increasing, which is very, very good. And right now a huge drop, 5% margin from 50. What? Of course, EBITDA That's bullshit earnings, but I will tell you what happened probably with this stock. It took me few weeks, I think. I don't really remember when I started this analysis, but there was something called churn rate. So people were buying the subscription and is then saying, meh, give me my money back. You know, when you get the new email address or whatever. And yeah, the law works like that when you are not satisfied with the product with subscription, you can just at the end of the month even, you know, write to them that something happened, maybe they will give you your money back. The credit card companies also have some money back stuff. It's a little bit complicated, but basically they bought something and then withdrawn. So they said, okay, I don't want it, give me my money back. And that what happened. The other thing that happened in the first quarter of 2024 was bank holidays. So some of the money didn't come in during this quarter because of bank holidays at the end of the period. I don't know how much of an importance that is, but yeah, we'll see. That money will of course come next quarter. I sadly don't know how much that will be, but when you look at their predictions, they are very optimistic, and I'm a little bit scared about that. I think that can be, I would say, don't scare the investors, but they are already very scared. Like we can see the price chart, that huge drop is not very good. So yeah, where was that financial report? They estimate that the worst situation on the market will continue, and they estimate that their net earnings will be between 10 and 20 million. So jumping from it is super low. Let me look at the net income here. If you compare it quarter to quarter, it also looks bad. Let me check the recording if it's alright. Okay, I think it will be fine. Alright, let's see that. What? I'm looking for net income. You can see the taxes paid, okay. Looks normal. What? Okay, in here you have earnings per share. So it went from 1.26 into 0.2. So what is that? A 99% drop? What the fuck? They took all of the money and bought back the shares. They were buying back the shares. They were talking about buying back the shares when the price was here on top. They were like, why our company is so cheap? And currently it's a little bit cheaper. If we look on Guru Focus, and here we can look for insider trades. Yes, wait, I have to click it. Alright, so you can see that insiders were buying shares. Here you can look at the price. So it's Ben Boss buying majority of the shares. He's one of the lead guys in the company. He's called Boss, Ben Boss, so obviously he's the boss. That's why he got the name. So the trade price, Ben Boss bought it at 26 here for the I'm sorry, I'm not gonna destroy your name by pronouncing it so badly. Carol here with 26 and Boss with 24, 17, 18 and 8 in here, so he is buying. But I looked at how much he's earning and he's spending pennies on that stock, but he's getting paid in stocks. So he's not only getting paid money, but around 30% is coming in stocks. So in reality he owns much more stake in the company than this. And the company made a lot of money. They made 1.6 million and they spend all of this, everything, on stock buyback. They didn't have to do that, they just wanted to do that. They spend it on the stock buyback. It's not a cost that you need to have, but they just went and spent everything. Sadly, look, I don't know what's happening, but they could buy more of those stocks. They only bought 10% of what they could buy, and they are holding 10 million in cash right now. They don't have that, so it's a huge position, and what that may suggest is that they need this money to survive, and I agree with this. Just keep it safe. They never took a lot of debt, which maybe isn't optimal, but they had some. So yeah, take it when you need it. I'm not the boss of your company, you know how to handle that. So it's safe. They're trying to play it safe, basically, and that's very important, because when you have an investment that has the potential of going 5 times in price, so you can earn 500% in matter of years, maybe it will happen in few months even, but let's say it takes 2-3 years for the price to go back, and for the earnings to go back maybe it takes 5 years or even 10 years. So if that company can survive, it can do well, expand, increase their earnings, go even further and achieve their goals. I know they had goals of 500 million of EBITDA per year. Currently they're maybe gonna get 300. It depends. I don't know how good are their estimates. The last estimate was much worse than they expected, so hopefully they don't overshoot or downshoot, I don't know how to call it. But yeah, if we look at price to book value though, you can see that it's 0.4 currently, I think 0.4, yeah, and that's really cheap, and you can get a lot of value. So look how you can, without having the access to the websites, how we can check what is the current ratios, because when the price drops so much, and with those small cap stocks the price can drop massively. I think my internet is dead. Hopefully it will load. Okay, weird. Okay, we are back. Market cap is 40 million, let's say. Let's round it up a little bit. It's not a big problem. And right now, let's say that the estimate for the earnings, in here they have the estimates, but they are much, I don't want to take those estimates, I want to go low end. So when they say it's between 10 to 20 million, let's say it's 10 million. So with the 10 million per year, and the current stock price at around 40 million, that gives 25% per year on a company that has no debt. It's not like they are going out of business, of course. Their earnings are dropping, but they have 10 million in cash. So they are, in my opinion, quite secured. They are expecting to be profitable in this year. So that's also nice. What happens when they get 20 mil per annum? They think it's possible. Okay, that's 50% per year. Is it possible? Who knows? I'm always using the lower estimate. This is also very, very important, and this is what's called margin of safety. You always want to make sure that when you think that the stock price is 100 and you think that the company should be worth 110 and you want to earn that 10%, there's no margin of safety. The margin of safety should be huge. It of course depends on the company, because when you are looking for something that's well known, like for instance, that's Coca-Cola, it's green because they are eco now. Alright, then having the price to earnings ratio of 10, or earning like a lot using this method, is unlikely. The Coca-Cola is such a big, defensive, nice brand and product and company that you are just not, it's very unlikely that you will be able to buy it at a very low price. But it's really nice right now because there's a huge boom on those technological stocks like Nvidia, etc. Connected to AI. Everybody is like saying that AI will really revolutionize our world, although the current program that we are using is not AI. It's called OpenAI, but it's a language model and not a generative AI that can think for themselves. But they are working on it. Oh, I forgot what I was talking about. Give me 1 second. Sorry, it's quite late at night. I was talking about the huge boom on technology, and that means that boring companies will drop down in price. And Coca-Cola is some old company. Is it fun? It's a fizzy drink. Maybe it's a little bit fun, I don't know. What the hell is this? It's Coke, of course it's Coke. That's the best part, right? Alright, let's look at the summary. So the current P ratio is 22. So it's not good, not bad. The utility companies should be lower than that. Oh Jesus. What the hell? Doesn't look depressed at all. I think kids might think that Coca-Cola is a little bit hype right now. Sorry, I'm not talking. I'm checking the utility companies real quick. Next Era Energy. Come on. the other company. Okay. The revenues are looking nice. Let's look at the price. It doesn't look so, yeah. Here we don't see the huge spike. The PE ratio, the price to book value looks very bad. The margins look amazing. Yeah, of course it's not so easy to say, damn, that's a lot of debt. Yeah, we might be looking at a shitty company, who knows? Or maybe at a good one. It's difficult to tell so real quick. I don't want to take a lot of time, but this is not like clearly, it's not like, wow. But maybe there is some potential in it, but I'm unable to tell right now. Okay, let's go back. We know it has potential to earn a lot of money, right? The second thing, okay, so we know that it makes a lot of money, that it has the potential. It will grow very rapidly also. Boom, boom, boom. We can see the revenues are growing rapidly, but this is the problem, right? We see this huge spike during COVID. Is it going to continue? That's the question I will have to answer. The second thing is looking at competitive advantages. So Mr. Warren Buffett is looking for three competitive advantages. The first one is the price advantage. The second one is the uniqueness of your service, and there are more comparative advantages. The thing to talk about is the monopole structure. So the company should be able to beat everyone else basically. And a good way to learn more about it is to read about monopoles, oligopoles, etc., how they form, what are like the characteristics of them, and if your company has that, if the company you will invest in has that, that's good. Invest in those companies. Get the dominators. Right. So, but you also have to compare it to the price. Is it undervalued or overpriced? Because you can get the best company with the best competitive advantage, but if you pay too much money for it, you will not earn a lot, right? Because if a company is worth 100 billion and you pay 500 billion, then you're overpaying a lot. And even if it makes 20 billion or 30 billion per year, so 30% per year, and you paid 5,000 for that, it's not worth that, you know. Okay, maybe not too good of an example, but let's look at other guys. We have the Netflix here. What are the problem currently with the US stocks is the weird high valuations of some of those companies, sadly. In here we have the Netflix PE ratio. So it's running at a very high PE ratio, median of 110. Wow. And now it's at 40. Really weird behavior. So probably the company is growing a lot. Yeah, it's growing. It's growing quite rapidly. The CLIQ is also growing, but doesn't have the P ratio of goddamn 40 or 400 like this company used to have. But maybe there was a sudden drop in earnings, I don't know. What is the P ratio of CLIQ? Let's say that we will earn 10 million this year. So currently we are sitting at 4 PE ratio of 4 for CLIQ. What's the PE ratio for Netflix? Is 40. Wow, that's not good, but look, steady increase in the revenue. That looks really good, really smooth. Let's look at the other metrics. The margins, how much money they are making. Return on asset is the best measurement to use here. Alright, so they are going up actually. The margins are looking better than they used to. Huge drop in 2011, but yeah, current ROA close to 20. That's very nice. And yeah, it would be nice to calculate an average here. Oh, actually in here, I think, yeah, it's a trend line, so the trend is around 6.2%. I don't think we can use this chart because of the huge drop. Okay, this looks much better. Yeah, the trend line, the earnings are going up actually, but when we look here at the price, we can also see that we could buy it for 186. Wow, that's so cheap. And right now it's 600. Oh my god, we could make so much money. But don't worry, if you are looking for cheap stocks, you can also find it. In here, Warner Bros. 8.6. Walt Disney 94, drop from 200, so more than 50%. In here also a massive drop from the levels around 26, 30 to 8. Wow, that's a real big drop. Okay, wow, the last time the price was so low in 2008 on the Warner Bros. Oh my god, that's so cheap. And the price to book ratio 0.47. Wow, wow, that's really low. Gross margins of 41%, but the net margins are very low. ROA also very low. So there's problem with earnings on this company. Yeah, the net margin. So overall everything, they are losing money. And they lost a lot of money here. Minus 35%. Wow, that's a huge drop. Okay. Wow. But look at that. Look at those revenues going up so much. Oh my god. Wow, the revenues went up so much while the operating income went down. That's crazy. Look, net income going down while the revenues are going up so much. That's really weird. Maybe they're heavily invested. Maybe they invest a lot of money. Oh, they're paying debt. They're lowering their debt. Let's see how much debt do they have left. How much time before they get that big money in. So, okay, this company has huge increase in revenue. So all of the money coming in, their business grown massively, but they are not showing any income. They are not earning any money on that. They have no profits. What? They are paying a lot of taxes. No, they're paying back their debt. And we can see let's see what they are paying. Long-term debt, that's what I'm looking for, and short-term. Okay, so there's not a lot of short-term debt, and there wasn't. And when we look at the long-term debt, it actually increased massively. So they took on a lot of debt. Ooh, that's complicated because we have to look how much they are paying. We can calculate that, but that will take me a moment. But let's look at that. Okay, here we are. I found it. Interest expense we have here, but we also have effective interest rate on debt, and it's around 5%. So they're paying around 5% on that debt. We have to check what's their return on assets. Can they make money? Okay, so we have the ROA, we have the ROIC, let's go with ROIC, and we have operating margin and gross margin and net margin. Okay, let's look at the net margin. So net, they are earning 10%. The gross margin is 62%. Wow, that's nice. Operating margin 27%. So from the core business activity, 27%. Wow. Return on invested capital. Okay, it dropped massively, but before that it was around 10%, so that's nice. And Warner Bros. Return on assets 3.27%, but their assets, it's probably a lot of goodwill and other weird stuff, so it's hard to say. But yeah, those margins are way above 5%, and they are probably going to make a lot of money on that, as they are showing currently. Let's see exactly how much debt they're paying. Why are you paying so much debt? Let's look at the income statement. The operating income is bad. So although the revenues went up, the operating income went down. Why? I don't know. It takes a long time to answer those questions. You can try answering them yourself, and it's probably a good idea if you want to make tons of money. Yep, but if we go back to the earnings per share that we could see before, 1.5, 1.8, 3, 1, 2, 1.6, 1.6, 1.5. Okay, let's take a rough estimate of 1.5, and current price is 8.55. So the PE ratio would be around 5, or if we take a higher estimate of, let's say, 2, that would be price to earnings ratio 4. But this company also has the potential to utilize all of that amazing revenues coming in. Look, if they make profit on that huge spike in revenue, let's say that we jump from 3 to 10, so that's a 3 times increase. So we jump from 2, or from 1.5 times 3, that's 4.5. The PE ratio will be 2. So such a great company, and we are paying it with the book value current of 0.4. Wow, those companies, that is looking promising. And Walt Disney, with the huge drop in price, as we can see in here. Can I make this a little bit bigger for you guys? Yeah, sure I can, probably. Yeah, if I can only move on the screen right now, that would be helpful. Okay, I'm sorry, I'm too old for this. Okay, but let's look at the basic indicators. Price to book ratio 1.73, PE ratio of 100. But we have a similar situation to CLIQ. There was a huge drop in earnings of the company. The old president even of the company came back from retirement or something to help it, because it was going into a weird direction, so we can see this huge drop in operating income, for instance. But if you look at earnings per share, in here we can see that before it was 7, 8, 5.7, 5.7, 5, 4.3, 3.4. So in 2019 it was around 7, before that 8 and 6. So let's say a smaller estimate of 6. We can go back to that level. And the current stock price is 94. 94 divided by 6, that's PE ratio of 15.6. So it will take us 15 times if that company doesn't grow their earnings. It will take us 15 years to get back our money, to double our money, double our investment, make 100%. Alright, so it just doesn't look as good as the other ones. That's why this analysis always gets easier at the end. Right now, when we look at those companies, or we look at the Netflix, for instance, you can see like in here 180, good place to buy. Right now at 640 with the P ratio of 40. I don't know, man. Like, compare it to Warner Bros, where you just get this huge spike in revenue, but of course that comes with debt, so that's a risk. But look, you don't want risk. In here you don't have debt. Will the market be better, or is this a problem that will go away? Is this downfall of earnings just this quarter, or is it going to continue? Are they going to be earning money, or are they going to be losing money? Are they going to close and sell everything they own? You know, who knows? It's always risky. But in this case, I look at it in a way that, okay, what's my risk to return rate for this company, let's say, when it keeps on growing so rapidly? Let's say that it only goes like, it's not only, but let's say it goes back to what it was a year before. Their estimates are not so much lower, but I think they will be much lower than they are estimating. But even if we say that, okay, we take the lower end of their predictions, it looks amazing. So even if they miss it at all, like they don't even get the low end, they make some shit year, and they make 50% less than they predicted on the minimum end, and 25 and 75% less on the max end of what they're predicted. They will be lower by 75%, so they will get completely smashed. There is also a huge upside to that. Yes, when the company can give you around 20% per year, that's a huge nice gamble to make, nice investment to make. I shouldn't call it gamble at this point. And you can really get nice returns, much better than the bonds that can be destroyed by inflation, by government printing basically. And yeah, you can get real nice money. And at Warner Bros, I will have to look into it more, because I can see it has potential. I think Disney is also nice. It deserves further analysis, because I spent like few minutes talking about it, and yeah, I didn't do in-depth analysis of Disney, Warner Bros, or Netflix. I know those companies, I know what they do, but it's not like I spend a month reading about it, or weeks thinking about it, etc. Even about the CLIQ, I know some information about the CLIQ, but it's still not everything. Okay, and lastly, as a bonus, I want to show you a few amazing websites. So the first website is Stock Circle. Look, do you want to invest your money real good? I have a great strategy for you. I'm using it. Copy Warren fucking Buffett or other guy who is like a genius, okay? That will give you money. It's very easy. You go to Stock Circle, in here, biggest holdings, you can just, you see what he is invested in, latest trades, so what he's doing, you can also see that. It's updated quarterly. It's really nice. He has a lot of money, so he's not, look, when you have a lot of money, you can only buy the big companies, so he doesn't have so much potential as other investors. But look, you can look at Lilu. If you don't know who Lilu is, then you need to know who Lilu is. He will make you even more money than Buffett, I think. Because he has smaller capital. He's also a genius. He's actually Chinese Warren Buffett, so that's also nice. If you want to invest in a highly undervalued market like the Chinese market right now, listen to some of the Lilu, watch Lilu on Stock Circle. If he makes any bet, then I will copy that. Macro trends, this is only for US stocks, but it's nice, it's free, it's clean, I like using it. Yeah, it has a lot of ads, so use adblock. My bad, sorry, it's a new laptop. I should download it right after I finish it. And Yahoo Finance, it also have mobile app. If you are looking for something real quick, some PE ratio, some price to book value ratio, go on Yahoo Finance. Also completely free. Trading View, if you are trying to look at the charts, it's great. If you want to look at the chart, like I'm going to look right now, it's one of the best free websites that you can basically use. Okay, so let's draw some random lines, downtrend, etc. It's very difficult to do technical analysis on a company that is so small. When there's 40 million in market cap, there could be investors who have that much money invested. You will have to check the shareholders. The shareholders look in a way that only a small portion is held by institutions. The majority is free float. I'm not really interested in looking at the short term. I'm buying this company for the long term, and I'm basing my decision on the fact that it's cheap. It's cheap. In here, I can see a support here. So if you are looking for entry point, I'm suggesting buying it right now. But if you don't know why not wait for it to do some correction and drop here? I wouldn't wait. But if you want to, yeah, you can buy it for 5.6 or something. Okay. And one last tip. The Nike, Under Armour, they also dropped in price. Maybe there's something there, I don't know. It's for you to look. If you like those companies, if you like Nike, if you like Under Armour, then great, look at that, and maybe you will make a lot of money. And yeah, that's the end. 1 hour 3 minutes. Thank you very much for watching. I hope you will make a lot of money with that. Of course, remember, even with the right idea, you can still lose everything. You can buy it using leverage, or just the psychological part is also very important and very difficult. So yeah, remember, always risk the money that you can afford to lose. And don't gamble, please. You are competing with people who have billions of dollars, who are against you, who are using technologies that you couldn't even dream of, and they're all against you. Especially if you are trading against robots, against computers, so good luck with that. The algorithms are based on some crazy physics theory. It's super complicated, the best fans do it this way. And yeah, stay careful when you are short term. And yeah, good luck. Thank you very much for listening. And yeah, see you later. Cheers. And one more thing, there will be merch in the future, or maybe it's already available. You can click the link in the description if there is a link. And yeah, I try to make the merch high quality. I have it myself. I'm happy with it. I didn't go with the first design because it was not design but manufacturer, because it was shit. Currently I like the quality, and I hope you will like it too. Thank you very much for listening. See you.